This morning. Join us right now for a look at the markets ahead of the open, though. I want to bring in Greg Branch, managing partner at Veritas Financial. Good morning to you. We're all trying to make sense of what feels like a bit of a repricing going on, Greg, and I can't figure out what is triggering it now. Is it just that everybody's back and they're starting to actually think for the first time?
I think that a lot of things emerged from the job report we saw, which was that the workers aren't being added. Our availability of willing workers is not increasing. And that leads to the question of whether or not we'll continue supporting robust job growth. And so particularly where we find the pressures most acute, most pernicious, leisure and hospitality, for example, we had zero net adds, but a very robust 130 basis points increase in wages. And so that is the part that the Fed can control. And I've been arguing for months that they should control. They can't control the fact that many of our sourcing and manufacturing economies around the world, Thailand, Vietnam, Australia, et cetera, that those are closed and that will continue to add inflationary pressure. But this is the part of inflationary pressure that they can and should control.
Okay, but let's just talk about what appears to be, I don't want to call it a rotation, maybe a baby rotation happening here. So if you're right about what's happening in the economy and you think it persists in this direction, what does that say about tech stocks? What does it say about some of the cyclicals? Where do you want to be?
I want to be in things that have three different types of insulation, that they are better prepared to deal with the inflationary pressures in shipping and delivery, that they are better prepared to offset or insulated from the rising wage pressure, and that they are able. So, for example, the acute wage pressure is really at the low to mid end. And so lots of tech companies, lots of financials aren't going to experience that, aren't going to have as much of an impact as leisure, hospitality, various sectors that have structurally lost available workers, maybe to the gig economy. So those are things I'm looking at. Even within a sector like value shopping, I've liked that a lot, Andrew. There are firms like Walmart and Target better prepared to deal with this than, say, Dollar General, which won't be able to pass on that pricing to consumers.
A lot of errors coming out. I wouldn't say a lot. Some errors coming out of big tech. You want to play tech? You want to be in tech right now?
I still think there's some very compelling stories. Absolutely. And where I'm looking in big tech, I'm looking at secular tailwinds. I'm looking at things levered to digital advertising, levered to the cloud. When you take a look at a name like Google, we're talking about 20% growth, 30% margins, trading at a market multiple on 22. That's still a story we can invest in and be patient with.
In terms of some of the other stocks, we're going to be hearing some earnings reports. We just mentioned Lululemon. We'll hear from the GameStops. What do you think of some of these companies that are sort of in turnaround mode? Maybe a fair way to say it. Right.
So this is a very risky environment to be betting on a turnaround, particularly where they're exposed to some of these forces I talked about. That's not the type of risk I'm taking on right now, particularly after the Fed kicked the can at Jackson Hole and still has yet to give us firm details, which we know to be forthcoming. I thought it would have been strategically prudent to nestle it into those robust second quarter earnings. And now this is what the market's focusing on for the next couple of months. And so I would have to see a verifiable story that I can articulate and have confidence in to take on that type of risk right now.
And then finally, what is the chance that Mr. Powell sees what's happening in the economy and says, you know what, okay, I'll sit on my hands for a little bit longer?
That report had something for both sides. You could look at the 235,000 ads and say, oh, we need to continue course. Or you could look at the 60 basis points of overall wage increase, twice what the street was expecting, and say it is now time to turn our attention to these somewhat structural, somewhat lasting inflationary pressures that accommodative policy is continuing to exacerbate.